we're going to go ahead and get started. And again, we're going to be talking about what makes an apartment syndication deal work. All right. So there's a lot of pieces that go into a syndication deal. And I don't think this is necessarily just for a syndication deal. I think this is any type of real estate investment. I think you can use this, you know, if you're doing a JV deal, a joint venture deal, or, you know, you're buying it yourself, or you're getting a duplex or a five or a quad, whatever. I think these are important steps. We use it in our syndication model, and it's what makes things work. But you can use it too. So when we are buying properties, we have a process that we go through. We use software to track our pipeline. And when a new deal comes in and is loaded into the pipeline software, we have a series of checks that it must go through to make sure that we've done everything we need to do to make sure the deal is accurate. Because we don't want a deal in there where the underwriting is inaccurate based on some faulty numbers, and we are projecting returns that are not achievable. And what you're going to see, I am going to pull up some underwriting here shortly and show you how small tweaks, we call them levers, how levers can be pulled, and it greatly affects the returns. And so because of that, deals are very tight right now. You need to be sharp in your underwriting. You have to be able to be accurate and know and be confident in your underwriting. So in order to do that, you need to run down through these checklists. The first thing we're going to talk about is going to be sales comps. And I am going to share my screen. I know everybody always asks me, I'm going to share another screen besides the webinar registration page. Yes, I am. Be patient with me, please. The sales comps, you want to see what properties are selling for in the submarket. I will place a caveat on this, an exception in this current market. It's moving very, very quickly. And so it's hard to have registered sales comps that are going to be equal to what you may be buying a property for, especially in the Class A space, where something sold 2 months ago for, let's just say, $250 a door. And now you have a deal that's $260 a door, and you can't find sales comps for that. You know, you have to, in that case, be talking to the brokers and know what things are trading for that haven't necessarily been booked into CoStar. That makes sense for you. While I'm running through this information, please be sure to type your questions in the Q&A or in the chat, preferably in the Q&A. All right. Let's go ahead and go to CoStar. All right, CoStar is what we use for our data. Can everybody see CoStar? Just want to make sure everybody's seeing CoStar. Say yes in the chat. I'm going to go ahead and talk about a deal. This is Ascend Waterley is what it was. We call it Braxton Waterley now. We renamed it. Ascend is attached to another company, so we had to change that as part of the purchase. But so we pull up the property here. You see it's 354 units. This is in the Orlando submarket and our Winter Garden of Orlando, basically. Actually, you know what? I'm going to stop share for a minute. I'm going to pull these all to the center so that I'm not looking off to the side. That makes sense. So I can look more at my camera while I am talking to you. All right, there we go. So we have the 354 units, 2020 built, asking rents on average $1940, $80 a square foot rents. That's current. Okay, so sales comps. We want to go ahead and go right to sales. All right, and we're going to look at what has sold in the area. And we want to see that based on a specific, I'm going to get rid of these photos here. So we have Cortland Reunion. It's a 2019 built. So you want to be sure that you're looking at something that's like kind. So I'm 2020 built. So this is going to be good for me. 338 units. I'm 354. So that's also good. Sale date October 2019. So that was, you know, a long, long time ago in the current market. So that is not going to be as accurate for us. And for some reason, it's not scrolling over for me. I apologize. What is happening here? I'm trying to see there. Oh, here we go. Sorry. There's my scroll bar. All right. Sale date, October. Bear with me. I just lost my spot there. There we go. What happened to my Cortland deal? Sorry about that. Let me refresh the page. All right, there's my Cortland reunion, and we're going to scroll across. All right, sale price, 70 million, so 210 a unit. Price per square foot, 175. All right, so I want to start looking at these numbers and determine if I'm buying in market. But again, remember I mentioned this is bought in October of 2019. And so it's not really going to be too accurate for my price per door, because I'll tell you, if I could get one for 210 a door in this sub market, then it would be, I would be jumping up and down. I'm pulling up on another screen over here what we ended up getting this for per door. Give me one sec. Yeah, I think we were right just under 260 a door is what we ended up coming in for. So you can see we're quite a bit higher than this. So I do see a 265 a door right here. So we can see kind of what that was and scroll back. All right. So 2017, 346 units. And I can go to these properties and kind of see what they look like. You know, is it comparable to what I have? There's not a lot of pictures there, but this is what we do when we're trying to look at sales comps. So I can X that out and go ahead and try to find. So I'm trying to make a case for what I'm paying for my property on a per unit price. So you got 265, 263, 243, 274. You can look at the sale dates, May 2021. You have February 2020, February 2020. And so I'm looking at those and I'm wanting to make a case for, am I getting a good deal on a per door basis? And then I'm going to compare vintage, what year it was built, average unit size, average rents that they were achieving. So we're getting 1940. So what are these other properties achieving? Let's just click on one and just check it out. Let's go to this one here. Vista Oaks, Kestra. Okay. This one does not have my rent. This is a different kind of metric. I'd have to go to the property at the property level instead of in the sales comp level for it to pull it up. But it gives you a good idea of what the property is. And so I can kind of look at their amenities and look at what they have going on and determine if it's going to be a comp to us. All right. So that's basically, I actually have toured that property as well. All right, so that is basically what we're doing for sales comps. Any questions on sales comps before we kind of move on from that? So that's basically what we do. That's one of the first things we do. Let's kind of see where everything's trading. Now, if you're in the market for any length of time, it's very, very easy for me to know whether this is a good deal or not based on the per door price, because I'm looking at deals constantly. Okay. So it's not, my team is looking at them. We know what the per door price is for like kind of assets in the market. I just know it. As soon as they say it, I know whether it's a good deal or a bad deal. We just closed on a deal yesterday. Blue Water at Bolton's Landing, same thing. I felt that the deal was under market when it came out. And so I quickly put a bid on it and tried to get it because I knew where things were trading. And so I felt it was good value. And I know when somebody says a number, I'm like, that's way over market. And I know that the underwriting is not going to work automatically before I even put it in there. And so it's really having your finger on the pulse of the market is going to help you quickly make decisions, but you still have to look at it. You can't just go off of, what you've heard, what you know there. You have to look at the data, because you have to be able to make a case for it to your investors. You have to be able to say, okay, here it is. Here's the report. I can print this report and I can show them, what I found. All right. So let me look at a couple of questions. What if I don't have CoStar? You can find some of the information on the internet in general. I'm not sure if LoopNet provides this level of information, but you can do apartments.com, I think is the name of that CoStar owns. I think so. If somebody can help me out on that, I think it's apartments.com. It's owned by CoStar actually, and they do share a lot of data. And so you can just go in and look at where the apartment is and kind of see what's around there. It's not going to really show you sales comps because it doesn't go to that level. It's because it's more designed for renters and what rents are, but you can get some information that way. You can also talk to the broker. And so say, hey, do you have any sales comps to support what you're asking for? What your broker opinion of value is, and ask them to send you some of the properties that they're getting the sales comps for. So definitely lean on your broker. All right. Yeah. Harsh. Thank you. Apartments.com. You can use that, especially for your rent analysis, which we'll get into in a minute. You can use apartments.com. So, if you don't, let's say, how far back do you look at sales comps? To be honest with you, I'm trying to look in this year because it's moved so quickly, especially this year. In the past, I would look maybe, a year or two, but it's moving so quickly now. I really have to look inside the year. And like I said, at the beginning of this, the one caveat to that, or the one exception is this year, is that I have to have my finger on the pulse of what things have been trading for. So when I'm bidding on deals, I know where we stepped out and I know where it ended up trading, even though it hasn't actually closed yet. I know where the contracts are being signed. I know what the per door price is. And so I can easily say, yeah, this is in line, even though I don't have to go to CoStar, but I can easily look at this one and I can find the sales and I can say, yes, I can make a case that there are properties that are like kind quality that are selling for more than I'm buying this one for per door. So therefore I'm not buying it top of market. I can still buy at top of market and still have the returns make sense. That's not necessarily going to kill the deal if I can't find that, but it is important for investor confidence. You have to be able to make a case for it, because if they say, oh, well, this is more risky if I'm, buying speculatively at the top of the market, my ability to achieve things, or for cap rate compression or expansion or exit is going to be affected by, if you're overpaying for this property. And so it's very important that you be able to provide that type of investor confidence by showing the sales comps. So let's move on, because I'm burning up time and I'm not getting through my material here. So rent analysis, let's jump onto that. Rent analysis. So I'm going to go to comps. That's where this is found here. And one question was, does CoStar have a free subscription? They do not. They like their data and they are proud of it and they want you to pay for it. So I'm not really sure what's happening here. Oh, there we go. All right. So here are my sales comps, just taking a minute. Give it a minute to load here. You can see where it's pulling. You can see the sub-market here, here over to the west of Orlando. Let me just refresh this and see if I can get it to load a little bit better there. So this is something that we do initially when we receive a property. It's not the final thing. We also go with our third-party property manager, which I'm going to show you what their rent analysis looks like. But we put together a rent analysis based on what we see here. All right, so you can see the property we're talking about here, right at the top. All right, and you can see now this is current, so this is not where it was when we bought it. It's gone up, so we've done well with the property already. So we were well under market, but just look for a minute at the price per rent per square foot. Okay, where are we when you just get right into this? 241, 203, 193, 193, 190, 186, 185. We are not the leader, correct? Right. That's a very good place to be. So then we go back over here and look at these apartments and see, is this going to, you want to be careful. You don't want to include like a high rise, right, as a comp to you. So you need to understand what you're looking at. This property has a 2-star rating, 241 square foot. So this is what we're looking at initially. And this is just a real quick overview. It's because if I get a property and they say it's a value add deal, you can put $7,000 a unit and you can raise the rents. Well, if it's at top of market, let's say I'm the 241 guy, why would I put a value add deal into play? Why would I want to spend money on when I'm already achieving top of market? I got no room to move and I don't want to be the leader. Okay. So that's why we want to make sure that we have room to move. And on this particular property, this was a lease up deal. So they were focused on velocity of rents. They want to get it leased. They were signing like 40 some leases per month, which is a big trajectory. But they're offering concessions. They stopped concessions before we took over, but they still weren't up to market. They were well below market because, again, even though they weren't offering concessions, they weren't charging enough. And so we were looking at the market rents and saying, okay, the value add here is bringing rents up to market. So in our underwriting, we have how many months it's going to take to do that, how many months it's going to take to burn off concessions, where, and loss to lease. Loss to lease is market rent versus what we're actually able to charge. We have a zero loss to lease because we use daily pricing. But this is part of what you need to look at. Now, this you can certainly do on apartments.com. You can find these rents here. Okay, so this is a basic exercise that we do. Now, I'm going to show you something. Let's see. All right, can everybody see that spreadsheet there? So this is also a rent analysis that our property manager has done. All right, so our deals are the ones, this is the recommended rate. This is where he thinks we can get. This is average. This is what they're getting. You can see right here, the price per square foot is much lower than it was that you just saw in CoStar. You see how much we're trailing the market. I mean, it's just, there's so much room to move. So you can see where we're targeting. Okay, there's recommended rents here. And this is put together by our property manager. We want to line it up with what we have and make sure that they are on board with the business plan. If they're not on board with the business plan, then the business plan will fail. If we're setting expectations that they cannot achieve, they don't agree with, then they're not able to do that. And so this is basically what we do on every deal. And I'm going to slide over one more slide. Okay, so here's market rents, what's shown in the trailing numbers. And then this is our pro forma rents. That's what we're saying we can achieve. And then we're looking at how long it's going to take to stabilize. We have all those numbers: stabilization months, 12 months, vacancy rate during stabilization, 6.5, stabilized vacancy, 6.5. So we're not really changing there, but this is where the rents go into the pro forma. And then, and so we're able to say what our rental increase is, which average rent premium was 0 because we're going to burn off concessions. We're going to burn off loss to lease. So we always want to underwrite conservatively. Even though you saw how much lower we were than market, we do not project very aggressively, because then if I don't achieve it, but if I can get the returns that we need and achieve our 7 cash on cash average, right, then we're going to do, then we're going to be able to exceed that. So we want to undercommit, over deliver. And you can see that that is the case in this deal. All right, so let me pull this down and pull this down. And now we're going to go into pro forma. Now, pro forma is what we want to see. Let me pull my underwriting back up. This is our pro forma from property managers and ours as well. So it's combined. You can see the rent analysis that I was just showing you. It's baked right into our underwriting. And we got the inputs here. So basically what we have here is, this is the trailing numbers. You see, we're using the trailing 3 months annualized, which is because this is a lease up deal. So their expenses weren't 100% in the early months. And so we want to get it as accurate as possible, but this is, we're using Red IQ. You can kind of see right here. I can change this to trailing 1 month, and let me change. Do trailing 1 month, see the numbers change, and it also changes my returns. I can do trailing 3 months back to what we had, and it's gonna change the returns. Okay. So what we have here is the trailing numbers, this is what they are doing things for. So other income, loss to lease, vacancy loss, concessions, non-revenue units. That's big because they're still stabilizing. Bad debt, that's people who aren't paying. Okay, then we have payroll expenses. This is all what they're achieving or what they're seeing. Turnover, utilities, administrative, marketing. Okay, so you get the gist, right? And then the pro forma is this over here. This is what we say we're going to achieve when it's stabilized. We're saying it's going to take us 12 months to achieve that. It's over here. And that is, these are the numbers that we're saying. And this is based on a pro forma that we put together and that a property management company puts together. And if I go to, so over here, this is very in-depth, and I don't expect you to get all this, but this is basically what we get on every single deal from our property management company. They were very easy. FCA, they're awesome. If you need a property management company, they are definitely B and A class, and on the larger side. So it may not fit everybody on this webinar, but they are phenomenal. They're integral to our success. I can say that. So you can see everything here through month by month. You can switch this to an annual view. See, it's right. Well, I won't mess with too much here. I just want to show you kind of what we do on every single deal. Let me see. All right. You can see we go through, here's all the unit mix. That's broken down by the rent roll, not just by what's on CoStar, because you can make some very big errors if you miscalculate how many one bedrooms there have versus two bedrooms. It can throw you off. Beginning occupancy, what we're claiming we're going to be at when we take over the property, how long it's going to take to burn off. Concessions, how many renewals. I mean, all of this is what we go through. Market rent, effective rent. So you can see it's pretty in-depth. Other income. Let me scroll up to the top on this one because this is kind of a big one. Administrative fees, application fees, bad debt recovery, bulk cable. We don't have that in because I'll show you, we put that in another spot. But these are all things that we look at for other income, late charges. These are all metrics that we input into the deal. Parking income, whether it's garages, attached garages, detached garages, reserved parking spots, if we have charging stations, all of that is factored in. Okay, everybody have a good feel for what we're doing there. I want to show you what that looks like on our underwriting. So right here is our other income board. We've worked very, very hard on our model to get it to where we need to be. And so here's everything. Before we just had an other income number and it was just the big number, and it just didn't make sense because we had to be able to break out what is making up this number. I mean, if you look at this, you got 343 and we're saying we're going to achieve $819,000 in other income when it's stabilized. So how are we achieving that number? We're bringing in dish fiber or Gigafy or some sort of fiber optic cable, private yards or pet yards, and the premium we can charge on those. We have application fees, pet fees, utility reimbursement. I'm looking over here at the names, and add amenity fees, parking garage. All right. So these are very crucial. I mean, look at the difference in income, $819,000 annually. And this is on top of market rent. So this is why this is very, very important. It's also very important to make sure that they aren't baking in some fees into their market rent. So you really have to dive deep and make sure that what they're saying they're getting rent doesn't include like washer and dryer fee or pet fee or utility fee, that it's actually rent. And then are they listing out these other fees somewhere in the trailing 12 months? Okay. Everybody with me so far? I know that that's a lot of info. And then the next thing, so we've gone through sales comps, we've gone through rent analysis, we've gone through pro forma, other income, debt metrics. Debt is such a big deal. And again, I'll pull back up this. And I think, all right. So I want to see, this is an older model that we have. I want you to look real quick at the IRR right here. Okay, focus on that number. And the cash on cash, average cash on cash 6.9. All right, so look at those two numbers now. All right, I want to go back to inputs and I want to change this to 80% LTC is what I'm doing here. 2.8. All right, now I'm going to go back. Everybody remember what those numbers were? All right, see the difference in the IRR and the cash on cash? That's pretty phenomenal difference. And that was a difference of, 5% on the leverage. That is where we ended up coming in at on this deal. So we underwrote 75 and 3.5. Now those numbers change as the market changes. But that can make a big difference. So if I just say, okay, we can go, let's go the other way. That deal's just making sense right there, right? That's where the returns need to be. So if I say I can only get 70%, and I think you're pretty good at 3.5, let's just say 3.6 is your rate. All right. You can see how bad the deal looks there and what a difference it makes on it. You can say, okay, agency debt is going to be 65 and it's going to be 3% right now. Low leverage, lower debt. All right. So not good IRR. Cash really wasn't affected because I lowered my interest rate, but I'm having to use more equity, right? So I'm having to get more money from investors. So IRR is going down there. So that is a very important factor. And you need to know what you're doing when you're quoting debt. And so that means you have to have constant contact with your debt brokers. And you got to know who you're going to have quote the deal before you even start underwriting it. So I base that based on who the broker is. So if it's Newmark, I'm going to go to the Newmark team, most likely. If it's Walker Dunlap, I'm going to go to the Walker Dunlap team. CBRE. If they don't have a debt team, then I'm going to pick who I like the most and who has done the best job for us. But I'm going to get them to say, hey, high level, this is the deal I'm looking at. What do you think? What's trading in the market right now? What do you think you can achieve? Okay, well, I think I feel comfortable with you underwriting this. I think I can get better, but this is a good, comfortable number. And use them on your team to know what those numbers are, because it can make or break a deal. You can make a big, huge mistake on that. All right, so let's look at cap rates. This is, again, we changed the cap rates. We changed our model, so we're entering it in different spots. So I haven't looked at this as much. Terminal cap rate, we're seeing it right here is 4.53 because we are expanding 50 basis. And that, let me just find where we have it on this because we changed again where our inputs were. Dun, dun, dun. Give me a second. It's amazing how your brain gets used to looking at a certain model and then we change it. Dun, dun, dun. Here we go. No, that's not it. And I should have pulled up a more recent model because we have been away from this model now for quite some time, for at least 6 months. My brain is already not working. But what we want to make sure we're doing is getting the cap rate correct. Let me just change this. This should show you. Oh, that's why. Year one operating cap. Apologize. All right, so let's go back to the summary and let's look at the cap rates here. The IRR and the cash on cash. And then if we go to the inputs and I was to change this. So if I'm buying this at, I think we actually only expanded like 40 basis on this one, but let's say 4.13 terminal cap rate. All right. If we sold it for what we bought it for, those are going to be the returns. If we sell it with an expansion, let's say it expands, let's say it goes to a 5. Okay. Like the market goes bad and we expand, 80 basis. You can see what the deal does right there. It doesn't affect our cash. It just, our IRR shows our upside when we sell is not there. So your IRR and your equity multiple are getting hit pretty bad. So cap rate is important to be accurate with the market. The reason I say that is, I don't mind paying a 4 cap as long as everything else is trading for a 4 cap, because then I know I'm accurate. If I'm buying it at a 3 cap and I'm, projecting a 50 basis expansion. So I'm saying I'm going to sell it at a 3.5 cap, but the market's at 4. I'm 50 basis under or paying too much on that. So I cannot achieve that. So if my underwriting is based on an inaccurate cap rate, then I will not be able to exit at where I want to. So the accuracy of the cap rate is important, not necessarily the number of the cap rate. You can buy in New York City at a 2 cap as long as everything else is trading at a 2 cap. And if that's just a kind of a measure of where you're at. So sales comps and cap rate. All right. So we had a lot of data there. I know I kind of burned through that. I just, it's a lot to get through. So I'm going to go back through the questions now. I'm going to stop my screen share. All right. Let me go through here. Is this a custom model or modified template? That is a custom model that takes hours and hours of time, and we're constantly modifying it and making it better and better. And every time we change it, we run it through everybody on the team to make sure we didn't miss anything, make sure everything's calculating correctly. But that is custom. And I believe that in the past we have shared a model not exactly like that, but very close to that. But I won't be sharing that today. That model that is proprietary. All right, what's your average property management fee? We underwrite. We get a little bit of a deal, so it's 2.5 to 3%. We have high volume, so we get a little bit cheaper. But if you're on a property that only has like 40 units, you're going to pay a lot more than that. It might be 5, might be 10%. So it just depends. But we're paying 2.5 to 3% on average. Got that one. That one. All right. So let's go down through. Hey, Carlos. Appreciate you, man. Great to meet you. What are your targets for IRR and cash on cash? So we have a range of IRR. Usually that's, the low end. I won't look at a deal. The deal will not make sense under a 10. But usually we try to get that around 12, 13, but it is getting harder and harder to do so. So I'd say 10 to 15 is going to be our IRR range. And when I say range, I say that because what I was just talking about cap rates, if I buy it at a 4.15, and let's say the economy gets better or market gets better, which I foresee, and the cap rate compresses and it's now, 4 next year, then my IRR is going to be high. It's going to be, maybe 18 as opposed to a 13. But if it expands and I have to sell it for a higher cap rate, say a 4.5 instead of 4.13 or whatever the case may be, it expands, it gets worse, then my IRR maybe 13. We underwrite the lowest end IRR to be with 50 basis expansion, and then we go from there. Let's see. And average cash on cash is 7%. That is going to be averaged over the whole period of 5 years, especially on lease-up deals is going to be very hard. So you're trying to achieve that 5%. And it's a pref in our model. So there is a catch up. If you don't get that in any year, you get caught up on sale. Please clarify why you use a T3 in one part of the underwriting versus T12. Okay, that's a good question. Income and versus expenses. So payroll was pretty much fully up on the expense side, so we could use a trailing 12. On the one I just pulled up, that one I had already toggled back to a T12, so that wasn't really what we were using for a T12. It also doesn't affect my numbers, except for like the entry cap rate, which is not really a number I'm too concerned about on a lease up deal, because it's really irrelevant, because all your expenses aren't there and you're paying this much for it, or all your income's not there and you're paying this much for it. It means it shows your cap rate as being, like negative sometimes, because it's not achieving its full income, and yet you're buying it now. So you're looking at stabilized cap rate on that case. So we will toggle the income or expenses. So it's based on how stable the property is, and how much concessions they have. And then on their expenses, like how many people do they have working on the property? But all I'm really looking at there is looking at my comparison. So what are they saying their payroll is? And is that based on the 12-month average, or is it based on a 1 month annualized? And now look at my number here. Does that make sense? Are there any big jumps? Like, okay, they're paying this much in marketing. They're only paying $10,000 in marketing, and I'm going to be paying $50,000 in marketing. But maybe that was on a T12 and they didn't do marketing, or whatever the case may be. That is why we adjust those. But it's just for a comparison basis, really. It's not for, it doesn't affect anything. We just want to see where, now on a stabilized deal, that is going to make a bigger difference. Pre-state, that's why you have to do that back and forth. I hope that makes sense. Your expenses insurance didn't seem to increase over the years. I don't know if property is in a storm pathway, hurricanes, but do you factor in storm damage expense? We do not factor in storm damage expense because we have insurance. We have our deductible underwritten, and we also have operating reserves for that. Property taxes do increase annually. I didn't show you my performance, which shows that the number you were seeing was just the initial entry. That's what we do at entry, but they do increase. So we have an expense increase annually, and we have a rental increase annually. Great question. All right, let me just go back through. Okay, how can you project a 5 to 7 year hold if the bridge debt is only good for a term of 3-1-1? So we only are projecting a 5-year hold on these typically. Sometimes we do a 7, but in that case, we're underwriting agency debt. And even if we did underwrite bridge, you can refinance that. But the 5-year hold is easy. 3-1-1, 3 + 1 + 1 = 5. So that's 5 years of IO. So we can underwrite that way. There's a penalty or a fee for getting the extension, but it's insignificant and well worth the money to get interest only. So that's why we do it that way. And the bridge is phenomenal. Number one, you don't pay yield maintenance. When you get to agency debt and you sell, then you have to pay the interest that you would have paid over the whole course of the loan. And it can really affect your ability to sell the property, even when in a hot market. So let's say you could get a phenomenal amount per door, but you got to pay $6 million in yield maintenance. Well, that's going to kill a sale and may have to be an assumption. So bridge does not require that. You can get away from that a little bit on the agency by going with a floating rate, but some people, they're steered to the floating rate. So that is why we like bridge. Bridge also has higher leverage, and it's LTC, loan to cost. So if you have any CapEx, it's inclusive of that and not loan to value, which is what agency is. Let me just go back through. Are you looking to pull out all your cash invested into a deal? No, only when we sell a deal do we want to, are we going to get our cash out of there? So all of our investors are in it for 5 years. Unless there's might be a case where we refi and return some capital, but no, typically not. We absolutely do. One question is, do you get any pushback on all the extra fees? Absolutely not, because I don't do this for free. And I hope you don't do what you do for free. I don't get up out of bed in the morning to spend hours and hours and days and months and weeks looking for deals for free. And so I charge fees. And also, if the investors were able to guarantee the loans and have the liquidity and the net worth and the credit to underwrite these deals and guarantee the loans, then they wouldn't need me. And so, and our team. So that we charge the fees, and and you should too. That's all I'm going to say about that. But there's a lot of people that say they don't charge fees, and that's just asinine in my opinion. So yes, I charge fees, and no, we don't get any pushback. Hope that answers the question. I'm sorry to be so candid on that one, but I know people that just like push back on that, and I just don't even understand why you would do that. We've underwritten something like 550 deals this year, and our uptake rate is 1%. And that takes a team of people that I have to pay, and they have to tour deals, they have to fly there, they have hotel expense, we have to network, we have to go, I mean, we have to take brokers out to dinner. I'm not just doing that out of the goodness of my heart. So how can we get a copy of your model? You can't get a copy of that model because that is mine. But there has been some out on the website, and I believe you can go to the website and get a copy of that. If you email me, I'll see if I can get that for you, but I believe it should be on our website, but that is not my lane. I think Danny usually is in that lane. Okay, one question is, do you get reports from the property management in Excel, or do you have a passcode to their property management software? Both. We get weekly reports from our property management company on where everything is, both current occupancy, pre-leased 30, pre-leased 60, pre-leased 90 days. And we have access to their software, so we can see it at any given time. There's a lot of questions. Wow. I really burned through a lot, and I apologize. I'm not going to be able to get to all these today because I'm going to cut a little bit early. But feel free to email me any questions. I'm going to go down through the Q&A. I'm just going through the chat, and there's like 20 that I missed. So if I didn't get to your question, feel free to email me. I'm very accessible, and I'll do my best to get them to you. We are very, very busy trying to get the end of the year out, working on multiple deals right now. Do you get a 30-year amortization on loans? I'm not sure the particular fee structures, et cetera, about bridge loans. Everything's going to vary. So I'm not going to get into the details of loans because that's not the purpose of this deal, but you have to be in touch with your debt broker. Things change constantly. Pre-COVID, we liked bridge. Then at one time we liked agency, and then bridge went away. So did Lifeco, private lending. It was only agency through the heat of COVID. And then now agencies leverage is terrible because cap rates have compressed. So they don't like the risk involved. So now bridge is back. So, I mean, it just keeps shifting, and you have to know what's going on. So the only way to do that is be in the middle of the deal. Do you recommend getting a lawyer for your first deal to review PSA? Yes, 100%, 1,000 times do it. I was awarded 16 years. Yes, get a lawyer. You're not a lawyer, and you will make a mistake if you don't get one. I am clearing out some of these questions. Well, on average, time for liquidating. So average hold time was the question. Average hold time is 5 years, but if the market goes well enough and we're able to sell it earlier, I will sell it earlier. That's the beauty of a cash flowing asset. I'll leave you with this. Everybody says, what if you can't sell it in 5 years? Well, it's making money, so I don't have to sell it. I mean, everybody's still making money. Yes, I can't return all the investors' capitals, but they also aren't having to worry about capital gains or 1031ing. So they're getting paid distributions monthly. And so I can't sell it right now. Okay. So everybody likes getting checks every month, so it's not a really big problem. And the beauty of it is, if we achieve the projected sales price earlier, then I can sell it earlier. We had a deal that we bought really this year. End of December is when we closed on it, and we've already achieved way past what we've projected on the sales price, and we're going to go ahead and sell it. Just because it makes sense to do so. Everybody gets their money. We're achieving returns, and we can, the market's hot right now. We're going to take advantage of it, and we're looking some other areas. So we took advantage of that opportunity. So I don't have to hold it for 5 years. I can sell it in 1. I can sell it in 3. I can sell it in 7. If I had a bridge and I'm having to pay interest, I'll probably have to refi to do that, but that's okay. And if I can't refi, I have enough reserves, or I have enough cushion in there to pick up the interest payment. So, I mean, that's the beauty of a cash flowing asset. Is there any part of these fees that you use for paying yourself, or do you use the whole fee chunk and put it back to grow the business? So basically, and this is not really the topic of this webinar, so I'm not going to get too far into that. Asset management fee Okay, that's the fee that we charge, the percentage of equity in a deal or the percentage of income of 1% is what we use to grow the team. Loan guarantor fee is the loan guarantor fee, and whoever the loan guarantors are get that fee. Acquisition fee is the acquisitions fee, and whoever was involved in the acquisition gets that fee. So that could be part of our team; they might get a bonus on that, or and whoever is in the GP, that's what that goes to. So not all the fees go into the company. Some of them do, but it, if you have the net worth and liquidity to guarantor a $90 million deal, that should be worth something to you, because not everybody can do that. So that is a value, and it needs to be, you need to charge for that. It's just the way it is. And just get that in your head. You don't do things for free. Same thing with all these things. You have to, you're in this to make money. Nobody has to be greedy. There's plenty of money out there, but you have to, you need investors to be comfortable with the fact that you have to spend time, you have to spend effort, you have to spend expense, you have to spend money, real hard money, to bring these beautiful, wonderful deals that bring them money. And because of that, you have to charge these fees. All right. So hopefully that makes sense to everybody. I'm up against the clock. I've got to run. Thank you so much for joining us. I do want to pull up real quick let's see, our next webinar, and I lost my control bar. Give me 1 second here. Pull this back up. There we go. All right. And look at that. I didn't even know this was a topic. Loan guarantors for apartment syndication. So you want to learn more about that and what I was talking about, loan guarantors and what's required. What's a loan guarantor, the role of loan guarantors on a deal, where to find a loan guarantor, selecting the right one, and how to compensate a loan guarantor. So be sure to tune in next time to the weekly webinar, and Dan's going to be talking about loan guarantors. So it's a good tie into this one. So be sure to check us out next week. Thank you all for joining us. Sorry if I didn't get to your question. Thank you all. Thanks, Carlos. Thanks, Harsh. Great to see you all. Great to meet. There were so many great people that in Colombia that I got to meet. I don't want to start naming names because I'll miss somebody, but had a wonderful capital raise event here in Colombia with many of these great people on this webinar. So thanks for being with us. I hope everybody has a great day, and I hope I was able to provide you with some sort of value. And I'm sorry if I went too fast, but trying to get you as much information as possible. But everybody have a great day, and we'll see you next time.